Welcome to another episode of The Breakdown. One of the big conversations that we're absolutely seeing with the upcoming UCP leadership race, but as well in regards to not only Alberta's economic future, but Western Canada's economic future and all of Canada's economic future has to do with resource development. And a lot of the focus that goes on with resource development tends to do with sort of the long-term goals of how we're going to decrease greenhouse gas emissions, how we're going to deal with carbon emissions, how we're going to make the transition to a more green energy system and a more green economy. But there's some steps along the way that we really should be paying close attention to. And one of those steps was really highlighted in a recent report from the Institute for Energy, Economics and Financial Analysis, or IEFA, as I'm told I can say they're called. And we're here today to talk with one of the architects of that report about what that report was and what it means. So we're very grateful today to be able to be joined by Omar Mawji. Omar, thank you so much for joining us today.
My background actually started in oil and gas. I looked at kind of small cap oil and gas companies, both publicly and privately. And then I had actually gone on to the tech sector. So I worked as a fund manager for a tech fund. Then went to go back to school, and I really wanted to refocus on climate and how climate investment or climate change and the transition to a net zero future is affecting the oil and gas industry specifically. And so that's where I landed the role at IEFA, focused on how oil and gas companies are going to transition and how investors and creditors should actually look at this transition and how they would look at investing in these companies through this transition. And so this is one of the reports that I think often gets overlooked. And I know back in 2014, when I was looking at oil and gas companies, decommissioning liabilities were not even on my radar. And so this was something that we wanted to tackle at IEFA.
Okay. Now, I want to get into sort of who IEFA is, and I want to make sure of a couple other things. But before we do, when we're talking about, decommissioning liabilities, would it be fair to use another term that we've seen more colloquially used in the news of orphan wells?
Yeah, so orphan wells are not necessarily decommissioning liabilities. Orphan wells are just wells that don't have an owner. So it's usually a company that's gone into receivership or has gone bankrupt and requires someone else to take care of it. That falls on the AER. So once it goes to the Alberta Energy Regulator, which is the AER, it becomes an orphan well. But decommissioning liabilities themselves are just assets like wells, pipelines, facilities that are being unused or have no economic value.
Okay, so they're wells that they aren't being used, but they still exist and nobody's doing anything with them, but they're still technically owned by George's oil and gas company?
Yeah, and so that company has to do something with that. They have to bring that asset, or they have to bring the land back to what it was. And so that's the liability that is being analyzed here.
Okay, and just to be clear, the Institute for Energy, Economics and Financial Analysis, I don't know if you've heard, but in Alberta, when people talk about oil and gas, we get a little squirrely. We've got this war room. It went after Bigfoot. It was a whole thing. Are you guys in any way affiliated with the Bigfoot lobbyist industry?
No, we're not. We're independent. We basically just write reports in the context of, like, what would an investor look at when they're investing in oil and gas companies in the context of the transition.
Okay.
Yeah.
So the war room should not be looking at targeting you guys at all then?
No.
Okay, perfect. So let's start to talk about sort of what the report was. You mentioned that it's looking at these decommissioning liabilities. If I was, I don't know, like an 8-year-old, how would you explain it to me?
Well, I would just say that, look, these are assets that have been developed by these companies. They've extracted all the cash flow they can from these wells and facilities and pipelines. And now that they have no value for them, What these companies are doing is basically they're just pushing this off further. So they're saying we don't want to deal with it right now because we would rather take the money we're making and give it to investors and pay down our outstanding debt. But we're not going to tackle this these liabilities right now because we don't have to. And if we don't have to, we can push it off as far as we can.
That sounds like a great way to eventually kick them to the AER for the Orphan Wells program.
Exactly. Yeah. And so that is one of the things that we are concerned about is that if, with what's happening right now in the industry where oil prices are at record highs, gas prices definitely are at record highs. If companies aren't willing to pay additional capital to bring down these liabilities, then when are they going to do it? Right. And so that is our concern. That's what we're warning both the taxpayer and specifically the creditor, because the creditor is really the last funder for these oil and gas companies.
Okay. Now, in the report, and in particular in the tweet that got our attention, and then got your guys' attention, it was a fun little back and forth. But in that tweet, there was a very specific number that was mentioned, and it has to do with the price of oil per barrel. What's the significance there? Can you explain that to me?
Yeah, so really what we did in the report was we did a case study. So we looked at 10 oil and gas companies, 10 small cap, what they call, I think it's between 200 million and basically they produce around 30,000 barrels per day or barrels of oil equivalent per day. We took a case study and we looked at under what price scenario would these companies be able to pay back their decommissioning liabilities, which in the report is referred to as asset retirement obligations. And so we with 5 companies in particular, we looked at Cardinal Energy, Surge Energy, Obsidian Energy, Pine Cliff Energy, and Bonterra. And we basically we laid out all their production. We included the wells that they would drill that they have in their inventory under proved reserves, so they're booked well inventory. And then we fluctuated the price of oil from $80 to $90 and realized that a lot of those companies still would not be able to fully pay back all their liabilities, their decommissioning liabilities, provided they continue to pay dividends to shareholders. And that is right now, that is the big worry, is that with increased free cash flow, that these companies, instead of paying down these liabilities, they're going to increase the dividends they pay to shareholders because shareholders are actually demanding it. They're saying, look, the future is uncertain. We don't know if we're going to get our money back in the future, so we want it now. And so you pay us dividends and we'll reward you with higher stock prices.
If I understand correctly, the magic number for what the minimum amount that these oil companies that you looked at would need to be getting per barrel is $85. Is that correct?
$85 would not be adequate for them, for all of the companies to pay down their liabilities. So, but when you look at the price right now, so around $100 oil and definitely, $5 gas, if AECO was at $5, it would be sufficient for them to pay back most of their liabilities.
Okay. But that's not what's being projected. I mean, Deloitte just put out a report in March of this year where they were projecting oil prices into 2023, 2024, 2025, 2026, kind of gradually decreasing and then stabilizing around the $70 mark.
Yeah. And so with the report, we used 85 because it was kind of the most optimistic. But yes, if you do look at kind of the futures curve, which is if an oil company were to sell oil in like 2026, they would be getting around 80 to $75 a barrel for WTI. So yeah, that is correct.
And WCS tends to hang out fairly closely to WTI, right?
It usually trades at around $10 to $15 discount depending on supply issues and stuff like that, or pipeline bottlenecks and issues around there. So right now, I believe it's at the higher end, above around 15, maybe above 15. but usually trades at a significant discount, and it's always traded like that for quite some time.
Okay. And just for clarification, because we're using some vernacular here, when we're talking WTI, WCS, for our listeners and for our viewers, can you tell what are we talking about there?
Yeah, so WTI is the benchmark that U.S. producers will get for their crude oil. So the closer you are to Cushing, Oklahoma, that's basically where WTI trades. So the closer you'll sell your oil to WTI. Because Canada is very far away from Cushing, Oklahoma, they will sell to their benchmark, which is Western Canadian Select, which is a heavier grade of oil with a higher sulfur content. And so they will get a lower price relative to WTI. And that all has to do with the logistics. So actually getting the crude to the refineries that can refine the oil.
Now that $85 mark, because I know we're going to get some questions in the comments, that $85 mark for WTI, is that American dollars or Canadian dollars?
That is American dollars. And so we adjust in the model, we adjust to have the current the current exchange rate between the US and Canadian dollar, as well as about a 12. We fluctuate the discount. We have between a $12 and a $15 discount to WTI for Western Canadian Select.
I guess the big question is, I mean, this sounds not good. Because the picture that you seem to be painting, and please correct me if I'm wrong, but the picture that you seem to be painting is right now we have a bunch of oil companies that are putting their focus on getting the maximum amount of money that they can out of their operations to their shareholders, and they're not putting in the attention that they need to put into in regards to remediating their well sites. And if the prices continue as projected, they're not going to have the money to remediate their well sites. It sounds like to me our energy sector is setting things up in such a way where we're going to have a bunch of well sites that aren't remediated. Am I wrong?
You are right. What the report so the report offers an out. There is an out. Right now, CEOs, banks, Alberta itself, they're not incentivizing these executives to tackle this issue right now. Executive pay is not tied to how many wells they abandon. It's tied to stock price. It's tied to free cash flow, financial things. Usually it's tied to. And so what this report says is that banks actually, who are going to be the first to be affected by this, can potentially incentivize these companies to tackle this problem right now. And so what we suggest in the report is that banks, as part of these covenants, so they'll have covenants that basically, if a company isn't able to meet a certain ratio, so a market value to free cash flow or a market value to operating income, they will restrict the amount of capital that they provide the company. And so what we're suggesting is that banks do this for these obligations, is they say, if the company does not abandon a certain amount of wells, then we restrict our capital to them, or we demand payback of capital, which will further incentivize these companies to think that, listen, if we want to secure debt for our future, we need to make sure we deal with this decommissioning liability issue right now.
One of the problems that we've had in Alberta specifically, though, is we get this sort of rotating door of oil companies where some guy will start an oil company and say, I'm going to dig these 5 wells. I'm making things up now. But some guy will say, I'm going to dig these 5 wells. They dig the 5 wells and they go, crap, we're bankrupt. And then they declare bankruptcy, walk away from those wells, kick them over to the AER, and then start a new company over here. Are there any solutions for how we can address that sort of thing?
So I think a lot of it is a resource issue. So like the AER does not have the capacity to really do a lot of this, and I feel bad for them. But I think that because of the Redwater case. So the Redwater case was basically that's what was happening, is these companies would take on these assets with huge decommissioning liabilities, without the ability to actually fund it at all. And then they would go into receivership, and they would have no way to pay. They basically sell the top assets to banks so that the banks could recoup their money, and the rest of it, all the bad or toxic assets, would then be passed on to the AER, and it would basically be the AER's job to clean it up, and that's where you get Orphan Wells. What the AER is doing right now is they're saying, there have been some pretty high profile potential acquisitions. So one of them mentioned in the report was Paraday Energy's acquisition of Shell's sour gas assets, and that acquisition was actually blocked by the AER. They basically said that this company does not have the adequate resources to fund the liabilities, therefore we're not allowing this transaction to happen. And so that is promising. But yes, you are right that one of the companies we mentioned is Pinecliff Energy. That's really their model. They would go into the market, no assets, and they would buy up these very cheap assets that generated a lot of free cash flow. But what people didn't realize is these assets were very mature. They were about to basically end their life. And so they would take on these huge liabilities. And we mentioned that they are one of the companies that are going to have to face this hurdle of reducing these liabilities. So yeah, it will continue to be an issue for the foreseeable future.
What's the motivation for banks? I mean, I understand nobody wants to lose money, but if for a bank to say, okay, you know what, what you described there, we're going to limit your capital based on how well you can handle your liabilities. What's to stop them from just saying, or we could write it off?
Yeah, I mean, they could. That could be their solution. They could say we write it off, but then the higher ups at the banks basically would be like, well, why are we writing off? Because I mean, the banks are exposed to, I think it's drawn credit of 50 billion or close to 50 billion, 40 to 50 billion in debt provided to oil and gas companies. Now, I don't know how much of that is Canadian, but you'd imagine a big chunk of it is Canadian because these are Canadian banks. That doesn't go unnoticed. Like if you write down billions of dollars in liabilities, shareholders of those banks will be like, okay, that's a big issue, right? We need, like, something's going on in the industry. And so I don't think banks want to do that. And I think the catalyst for banks now is the Redwater case. The fact that the AER is now the most senior creditor, and then the banks fall underneath them. That is of main concern for these banks, and they're now looking at ways to minimize their risk associated with lending to these oil and gas companies.
Did your organization, did the report look at any? And I mean, I know with our current provincial government asking them to make any sort of policies that are in any way restrictive to oil and gas is it's a bit of a wish on a star. But are there any policy recommendations that your report produced at all?
So we looked at it more from an economic perspective. So we looked at a market-based solution, and we feel like there are companies both on the production side, on the services side, as well as M&A and banks. Like they are all investing in tracking how big these liabilities are, where the risk is, so that they have an advantage in assessing, where to lend to or where to do the best transactions for your clients, right? And so, the companies are already investing in it, and there is a market-based solution that exists. And what we're trying to do is we're trying to, push a lot of these smaller companies to start investing in that, and push a lot of these banks to start considering these things.
At the end of the day, I'm going to ask for both. What's your worst case scenario and what's your best case scenario?
So the best case scenario is that, I look at, I'm picking on a company, I guess. So if you look at Obsidian Energy, right, last year, they spent about, I think it's about $8 billion or $11 billion, or sorry, not billion, $8 or $11 million on spending on abandoning their decommissioning liabilities. And then the government provided them with an additional, I think it was like 8 billion or 8 million. And so basically the government paid for half of the decommissioning work that they did. If if those companies under these new oil prices and gas prices can increase their decommissioning work relative to the free cash flow that they make, then that's a start, I think. So that would be a best case scenario, is that as oil prices continue to climb and as free cash flow increases, they pay substantially more. So instead of paying 11, they're paying 20, right? But I think that has to continue to increase. So they can't bring that cost down. And so the best case scenario would be that these companies just focus on these liabilities for now, reduce the liability as much as they can in this new oil price environment, and then start to pay back investors, right? The worst case scenario is that because these companies are incentivized through share price improvement, they will take all the free cash flow that they have, spend it on share buybacks, spend it on dividends. They will not increase the amount of spending that on decommissioning liabilities, and that those liabilities will continue to increase year over year until they become so big that basically banks have to write off all their debt, and the AER has to take on this asset, this liability. And that, we see the potential for just the 5 companies we analyzed. So of the 5 companies we analyzed, in an $80 oil price environment average over the next 20 years, which is not, some unforeseen case, their liabilities will increase from 700 million from those 5 companies to almost 1.8 to $2 billion. So that will be $2 billion in liabilities that, if they can't recoup any money, it goes straight to the Orphan Well program, and the taxpayer has to pay that $2 billion. So that is the worst case scenario that we see in this, and that's just 5 companies.
I was just going to say, and that's in addition to the inventory, I guess would be the right word, of orphan wells that the AER is already responsible for. We saw the feds push a whole bunch of money to Western Canada to try to make a dent in this issue, but even that amount, I've seen reported that it's not enough. What are you betting on?
When this report came out, oddly enough, a lot of the industry actually reached out, and so I'm not confident, but I'm happy that they're at least considering this, that this is not just like some aside for them. So I'm hoping that at least the banks take note of this, and they adopt policies that restrict the amount of capital that they provide these companies if they don't bring down their decommissioning liabilities. And I think from that, you'll start to see it's almost like a waterfall effect. The banks will adopt it, then the M&A houses will start to adopt it, then the companies will start to adopt it, and it'll be really a race to the top instead of a race to the bottom. So, companies will, in order to attract capital, they will be very responsible in the way they decommission their wells and their facilities and their pipelines, and then they'll be the ones that get the most capital. And so I think that I'm hoping that that's what the industry gets out of it. I think it's, having been in the oil and gas industry, I know sometimes it can be, people get their back up against the wall, and they're like, oh, you hate oil, but that's not the case at all. It's like oil and gas executives have to consider making investments in this new environment. You can't ignore the fact that there's a price on carbon, and you can't ignore that potentially demand for oil will soften, maybe not this year or next year, but over the decade, right? And so they have to make these tough decisions today to save their future.
Isn't there an argument as well, and I know it's not the sexy money argument, but isn't there an argument as well that if leaving these wells longer than necessary, leaving them unremediated is just bad?
Yeah. Well, yeah, it's bad. It's like when you have a roommate and you're washing you put your dishes in the sink and you don't soak them and you leave them there for days, right? It's bad. Like, it's just not proper, right? You don't, as a company, you don't own the asset. You're taking it from, or you're not taking it, but you're borrowing it from the Alberta government. So you should replace it in nice condition, because it's not your asset to destroy. Like, it's not your land to destroy, right? And so I think that, yeah, it's bad. It's, you know.
Like I said, not the sexiest argument to be like, it's just wrong. That's all there is. But is there anything else that you'd like people to know about the situation? Is there anything else you'd like people to know about the AIFA or any work coming up that people should be watching for? Because like I said at the beginning, it was really quite stunning to me how this report came out on social media, and it immediately, whoa, $85? That immediately caught my eye. But it seems like it didn't land with the, pardon my language, but like the oh shit that it probably should have. What do you want people to hear?
I think that one thing this report was meant to highlight is that ESG isn't just in the form of carbon emissions. Carbon emissions are part of the environment, but these small things like decommissioning liabilities and bringing land back to what it was, that's part of the environment. And so companies should be responsible for that, and you should, as a person that lives in Alberta, you should want your province to go back to the way it was once a company's done with it, right? And so I think that that's kind of one of the main things. I think, it's not doom and gloom. Like, if companies take this seriously, and if they take the money that they're about to make, and instead of paying it to shareholders, they pay it to bring the environment back to what it was, it can be solved. There is, like, the technology exists. All it takes is spending. So it's not a technology issue at all. And yeah, I think that, I think spending a lot of time in the oil and gas industry, this is the first time, I think, in decades, that the industry has to make a big shift. They have to make big decisions on how are we going to exist in this new energy environment where energy is diversifying. There's a cost on carbon. People don't trust the industry as much. How does a company operate in that? And that's what we're trying to figure out through these reports.
If people want to learn more about AIFA or the work that you're doing, where can they go?
Yeah, we have a website, so aifa.org. Just go on there, look at a bunch of reports. You can search my name in there because I cover most of the Canadian stuff. We have like a report on LNG Canada, and then we have some upcoming reports on carbon capture and the hydrogen hubs that we're planning in Alberta. So we're doing some analysis on that, and that should come through in the pipeline. So yeah. So
cool. Yeah. For those who need the letters spelled, because I would spell AIFA all of the wrong ways, it's IEEFA.org. And if you search Omar's stuff, not only will you find the stuff that he's written on, but you'll find what I would argue is probably one of the happiest profile pictures that I think I've ever seen on a corporate page.
I'm a very happy person. So
clearly, like, it just, yeah. I was going through it earlier. I was like, wow, that guy's got some enthusiasm.
Yeah. I love energy. What can I say?
There you go. Omar, I want to thank you so much for taking the time to chat with us today. We're going to include a link to the report in the show notes that we do, both for the podcast as well as for the video. And please keep us in the loop in regards to what you see happening. If you start to see the banks making these changes because they're the right things to do, not only for the environment but for the future and for their financial future, we would love to hear about it. And if they don't, then we would definitely love to hear about it.
Yeah, I'll let you know. And thanks for having me on, Nate. I appreciate it.
Awesome. That. Thanks so much.
All right.
As always, if you appreciate the kind of content that we're trying to produce here at The Breakdown, we would love it if you swung by our Patreon page at www.patreon.com/thebreakdownab and signed up for a small monthly sponsorship of the work that we're trying to do here. It is because of the support that we receive from our Patreon sponsors that we're able to continually up our game, and it is tremendously appreciated. So I want to throw a big thank you out to them, and you can go ahead and visit that website and join and support us as well, because we need all the help we can get. Thank you so much for your attention. Thank you so much for listening and being part of these important conversations. And we will see you next time on The Breakdown.